The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
First session lows for the markets, trying to send a message to Washington, but is anyone out there listening? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. The lesson, don't take risk into a weekend of massive uncertainty. Absolutely. Let's take a look at the scores and where we set up here. The S&P is down a whopping 5.5%. A huge sell-off here over the last 2 days. We're down for 2 straight weeks, the most in March of 2020. I could go on for hours with the superlatives, but I will move on to where people are putting their money, and that is the bond market. You get 2-year yields down by 1 basis point, but over in the 10-year, you got that down by about 4 or 5 basis points. The dollar also really weird and interesting price action, Romaine. We saw the dollar index hit the lowest level since the election and then rallied the most since the election. So a lot of whippy action happening in the currency market, and crude just getting whipped here at $62 a barrel. And
you go back to the equity market, only 16 stocks in the S&P 500 are higher on the day, the most volatile day for financial markets in at least 5 months, capping what will likely prove to be the most consequential week for financial markets in 5 years. The S&P firmly in correction. That means down more than 10% from that all-time high. So too is the industrial average. The NASDAQ 100 on the edge of a bear market. Dow Transports, the Russell 2000, the KBW Bank Index, they're already there with the bear. Equity option volume right now, that actually jumped to the second highest on record yesterday. Right now, today, it's on pace to surpass that. That's creating ripple effects across broader capital markets. StubHub, Mountain, Chime, Klarna, all said to be postponing plans for their IPOs because of market volatility. Nintendo delaying pre-orders for the new Switch 2 because of tariff uncertainty. Stellantis offering discounted pricing on some vehicles amid consumer anxiety. And not a single corporation today or yesterday has been brave enough to sell new debt. Fed Chair Jay Powell at a pre-planned speaking engagement was expected to sugarcoat things in that vague way that really only he can. Instead, he delivered a bit of a spoonful of medicine that was hard for the market to swallow, saying, yes, indeed, tariffs, the economic impact of which may be significantly larger than anticipated.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
Jay Powell speaking a little bit earlier there, Alex, he did nothing really to help markets. Not sure there was anything he could do given the big spike that we saw in volatility this morning. Exactly.
Let's talk about that spike in volatility. Nice setup for me. So the white line is the VIX and the blue line is the S&P. And this is the comp chart here going all the way back to 2001. So I wanted to point out some of the big VIX spikes that we've had, right? The notable one here, 2009, and you saw the index move lower for the S&P. And you can even see it in the little one. Spike here, index goes lower, spike here, S&P goes lower. Going back to 2020 during COVID, you see a big spike in the VIX and you see equities move lower. So we've seen this action happening, and now you have the VIX at 44. I mean, we have not seen this since 2020, the biggest 2-day jump since 2018 at one point. So do we need to see more selling on the S&P? Now, on the flip side, the question is, are we finally seeing this become a macro event and finally seeing it become capitulation? Higher VIX, you get more of a sell-off. The majority of the stocks in the S&P are all selling off. At one point, you have now 28% of stocks are now making 52-week lows. 26% only are above their 200-day moving averages. Are we getting to this washout point, Romaine?
Well, we're back to session lows here for most of the major indices. And Alex, the S&P now deep into oversold territory with the 14-day RSI down around 23. The VIX back near the highs of the day. And your question about capitulation, well, let's pose that to our first guest as we kick you off to the close here on this Friday afternoon with Julian Emanuel, Chief Equity and Quantitative Strategist at Evercore ISI. Is this what capitulation looks like?
This is the start of capitulation. Mm-hmm. I can say that our phone calls with clients today had a distinctly different tone than they had yesterday. There is definitely fear. And look, it's obviously very uncomfortable, but this is how bottoms in markets start. You mentioned, record option trading volume, the bearish sentiment, the readings that we've only seen more bearish at the bottom in the financial crisis in 2009 and the bottom of the Gulf War crisis. But essentially, you do need to see a little bit of that fear. And the typical market cadence around major volatility shocks like these, and do remember that chart you just showed of the VIX, volatility spikes don't last very long, okay? That's why they're called spikes.
Yeah.
And you do tend to have the turnaround. But typically is that, traders very reluctant to take risk into the weekend.
Yeah.
And then, Monday tends to probably be difficult, and they don't call it turnaround Tuesday for nothing.
But I am curious. So one thing that we saw today that maybe gets into the minds of investors was that huge spike higher that we saw in a lot of retail and apparel stocks. There were some headlines saying that Vietnam was seeking a 3-month extension. Trump had some comments himself that seemed to suggest he was open to negotiation. And you had big retailers that are heavily dependent on that global supply chain, like Nike, Wayfair, go from deep in the red to high into the green. And most of those names are stayed in the green. Is that a sign that investors are willing to come back should they get that all clear or some semblance of all clear?
It is a sign. There's been plenty of damage done. I think we can all acknowledge that. The one thing is, in our mind, we haven't done sufficient damage to say that a recession moved to anyone's base case. We don't think that's the case. And if you accept that and you believe that there's going to be some progress, deals done, et cetera, and Vietnam was a good example of that, the appetite to put money to work is still going to be there in our view.
The last 10 years, though, it's been about U.S. exceptionalism and capital flows into the U.S. Some of this is going to be structural change. And if that's the case, does that capital really move out of the U.S.?
Well, we don't think it has to be sort of the zero-sum game that a lot of people are saying. And frankly, during capital formation phases, and granted, the exceptionalism of the U.S. over the rest of the world has been very extreme over the last decade. And we go back to the last time where the rest of the world outperformed the U.S., and that was 2003 to 07. It didn't mean that you were going to be a seller and have bad returns in U.S. stock. U.S. stocks rose 100% during that period. So we do think that there is an argument to be made once we get some more clarity that all boats will float.
Once we get the clarity, in the meantime, where do you hide out?
Again, it's too late to protect from an options point of view.
Yep.
And we would say that also the defensive sectors, healthcare, energy. I mean, look what's happened in energy the last several days. This is a time where instead of thinking about where you hide out, as a long-term investor, you look at your asset allocation, and what you should be doing is being very diligent and disciplined about reducing your fixed income exposure and gently tiptoeing back into stocks.
Reducing fixed income exposure now with the idea that maybe we're near a bottom in equity, so in theory you'll get a better return.
Well, and again, if you think about how asset allocation works, is that you reallocate during extreme moves. And when you think about stocks and bonds, and remember, part of what's been different about this entire bull market is that you had an extended period where bond yields rose at the same time stocks were rising. So it isn't going to be sort of this risk-off mentality into infinity.
Do we get back to that risk-on mentality that had really sort of propelled this market over the last couple of years?
Oh, it's going to take a healing process, no question. Can we? We do think you can at some point, but you will need to see fundamental catalysts that resolve some of this policy uncertainty.
I just have this is somewhat more of a personal question. I mean, as you sort of were sitting there on the sidelines on Wednesday night, listening to the president speak and then seeing the market reaction start to unfold over the next few hours, were you at all worried? I mean, I know you generally have a tinge of optimism, even in bad times, but was there ever a sense where you just kind of felt, okay, this might be a lot worse than we thought?
Look, whenever you have a set of circumstances where you're calling the phrase Smoot-Hawley into action, you cannot get away from the fact that there's likely to be volatility and uncertainty. And look, that's what we've got.
What is the biggest oversold part of the market right now?
No question about the fact that it's the technology and the AI theme. And we would say, and we've been big fans of the long-run potential for productivity from AI. And we think that is where, when the bottom identifies itself, people are going to go first.
Yep, the SOX index down for 7 weeks. Worst losing streak since 2002. These are the superlatives. All right, Julian, thanks a lot. Thanks for pitch hitting for us on a Friday. Julian Emanuel, Chief Equity and Quant Strategist over at Evercore ISI. So Fed Chair Jay Powell signaling earlier today that the Fed's going to stay on hold while emphasizing the economic impact of new tariffs is likely to be larger than expected. Here with more insight is Diane Swonk, Chief Economist with KPMG. Diane, always a pleasure. Have you changed your economic forecast call?
We have. In fact, we have now moved to a little bit worse than our worst case scenario, and that's because the tariffs now are likely, if they, even with some rollback and some negotiation, they could easily hit the highest level since the early 1900s. That, with more retaliation, would get us into a recession, but a stagflationary scenario, which is what you heard Jay Powell talk about, that the risk to inflation were to the upside now and the risk to growth were to the downside. And that is a very hard place for the Fed. He also talked about how it would take several quarters, our own analysis as well, even with the declines in commodity prices that we are seeing out there, the pass-through of these tariffs to consumers in terms of consumer inflation is still enough that the Fed will not be able to cut as much as the markets would like it to preemptively.
So what do you think they'll actually be able to accomplish? Because Jay Powell definitely talked about the risk to inflation in some ways a little more and in the foreground than growth.
Exactly. And this is where, remember, in the last several weeks, as tariffs have talk and months, as tariffs talk has been ratcheting up and actual tariffs have been levied, the Federal Reserve and leadership has talked about evoking the 1970s as a cautionary tale. The wrong thing to do when the embers of inflation are still smoldering is to cut when you're going to have a supply shock that's likely to also have a stagflationary aspect to it. Over the longer haul, the Fed's goal is to get both full employment and price stability. You cannot achieve that in the lessons of any other central bank and of the 1970s if you cut too soon to ease the pressure on employment. That could actually give us a more pernicious bout of inflation that it would be harder to get rid of, and stagflation. They do not want to get into that scenario.
I am curious, though, when we look at the business side of it, meaning the people that are effectively going to be making the decisions about whether to lay off or at least to curtail hiring altogether. Is there a message that they could send, that policymakers could send to that cohort to maybe just hold the line for a little bit longer? Because if indeed this ends up being transitory, for lack of a better phrase, then maybe you don't do anything.
Well, at the end of the day, a lot of the businesses that we're dealing with are feeling a bit of a paralysis from the uncertainty itself. And, that's because they don't even know how much they should try to hedge tariffs, whether or not they'll stay in place. Is it worth it to reshuffle supply chains when we could see literally these kinds of tariffs be lifted with the stroke of a pen? There could be a major shift in policy. There could be a major course correction by the administration on tariffs, which would change the trajectory. But right now, we're in a situation where it's very hard to, even with the tariffs we already had in place, of not seeing some kind of a mild bout of stagflation. And that is what is the optimistic scenario, even has that in it. And that's because even if the administration were to ratchet it back on many of its tariffs, it still has tariffs that are going in place and has additional work being done on tariffs to levy on semiconductors and pharmaceuticals going forward.
Well, I am curious then, how long would it take to sort of pull, if we do get into a stagflationary scenario, what can be done to sort of pull us out of that? And I've raised the question, there's been a lot of Trump administration officials that have been making the rounds in the media, including the Council of Economic Advisors chair, who has actually been positing this idea that once we get to congressional budget talks, tax cuts, some of these other policy proposals, that could be the economic juice that would blunt, if not completely erase, the impact that we're seeing from the tariffs.
Well, what we see, and we do have extensions and expansions to tax cuts in our forecast for 2026. And what we see going is that you get this sort of several quarters where you get elevated inflation. It then comes off as the Fed holds the line and then is then able to start cutting late in the year, not as soon as the financial markets would like. And I think that's exactly what Chairman Powell was telegraphing today. And then as we get into 2026, the effects tend to dissipate more, and you do get a little bit more of a boost from those extensions and expansions to tax cuts. We have that in our forecast. That still doesn't stop the growth rate from being subdued even in 2026 if the tariffs stay on. And I think that's very important to remember. Their immediate effect tends to taper off, but they don't go away until they're fully lifted or until we get more resolution on where we're actually going to be. That weighs on uncertainty. And we've even seen Congress itself pushing back against the idea of the magnitude of the tariffs that are being done via executive order.
So you mentioned sort of inflation going to rise fairly quickly. How quickly does growth fall in comparison?
Well, we actually have growth contracting in the second quarter now by a very mild amount, and then going into the third and fourth quarter. So we have a 3-quarter contraction, but not a major contraction, a slow contraction. So it's just barely into the negative, except for the third quarter, but that is a recession. And the unemployment rate moving up. But slowly, we've seen prime age participation in the labor force the last 2 months in a row actually decline, even as the overall participation rate picked up in the last month. Prime age participation has declined. Part of that is due to the fact that foreign-born workers participate at a higher rate, and they're not entering the labor force as rapidly as they had been.
Diane, something that we've seen over the last couple of days, Stellantis and Ford lowering the prices on their cars to get people in the door, kind of get their inventory off the lot. Is there going to be like a weird deflationary impulse on tariffs in the beginning before we get to those higher levels?
Well, there are certain things that are already coming down in price, like commodity prices and the price of gas, and those clearly help to blunt this. And certainly anything where you see people trying to get rid of inventories, that would help to blunt the initial effects of the inflation. And, you know, we're not talking about the kind of stagflation like we saw in the 1970s, but what the Federal Reserve is worried about is not just that initial bump we get once the full effects of the tariffs kick in. What they're worried about is the secondary effects and the residual effects of that going forward. And that's why they don't want to cut too soon, because if there is a secondary indirect effect that lingers, they want to be able to make sure that they get that out of the economy, and the economy is in a position where it can move forward without inflation in 2026.
So as we get deeper into this year and we start to actually see the material impact from some of this and maybe some of the blunting effects, if they are indeed coming soon, I am curious, Diane, as to whether you think the economic conditions will be sort of universal, meaning the type of pain that we're going to see and maybe the potential rebound that we're going to see is going to be across the board, or is it going to be a little bit more disjointed, like K-shaped recovery, as we used to talk about?
It's absolutely, inequality is really up first and foremost in this. Not only are tariffs like a massive sales tax, which is a regressive tax, hitting low and middle income households disproportionately hard. It also hits smaller and mid-sized businesses harder because they have less of a margin to absorb the impact of tariffs, and they have less wiggle room to pass it on to consumers. So they're much more crunched by having to do layoffs and having to pass some of it along, just given the magnitude of what we've got. So it spurs inequality across the economy, not only in terms of accelerating the inequality in an economy where the 10% of households, top 10% of earners, are now accounting for nearly half of all consumption, according to Moody's. That gets even worse, where you also have, on top of it, small businesses and mid-sized businesses, which really saw a bit of a renaissance in the wake of the pandemic, now getting clobbered as well, and more concentration of economic power in large companies.
Diane, Always appreciate it. Diane Swonk, chief economist over at KPMG, as we continue to focus on the markets and the economy. And some of the more interesting stories on the day, a wild ride for a lot of the retailers out there. Wayfair shares going up, down, and then back up again. Shockwaves in the tariff world as people try to assess how long those tariffs will last and whether more exemptions will be carved out. We're going to take a closer look at this in our Top Call segment. Coming up next here on The Close, this is Bloomberg. With the markets in turmoil once again, let's get a view from the sell side with top calls. The big movers on the back of analyst recommendations. Nordstrom, Citi, downgrading the retailer to sell, flagging concerns about the pending take-private deal by its founding family and the Mexican retailer El Puerto de Liverpool. The analysts seeing limited upside for the stock if the deal actually closes, but a steep downside if it fails. The shares down about 2% on the day. Next in line, let's take a look at BTIG, clocking out on Upwork, a downgrade to neutral there, with the analyst citing concern about the employment recruiting platform's international exposure at a time when economic growth may be slowing. Also some concern here about AI-driven job displacement. He says now, actually a good time to move to the sideline. Shares there down about 6.5% on the day. And finally, Wayfair, Citi cutting to neutral, with the analyst saying that while the furniture retailer is well positioned long term, the scope of tariffs coming for essentially every input market creates risk to revenue in the short term. Those shares, though, bucking the trend, up 5%. And those are some of our top calls. The man behind that last call, though, he joins us right now. Ygal Arounian is Director of Internet Equity Research over at Citi. And Ygal, you saw the numbers on your screen. Really a testament, I think, to just how volatile things have been. A stock, of course, that had hit some depths yesterday that we hadn't seen in quite some time. And then you had some headlines earlier today that maybe there's a reprieve coming from Vietnam, where a lot of these companies source their materials. Can we count on that?
We count on the reprieve. I'm not sure what we can count on these days in terms of what tariffs are going to hold and what aren't. The way things are set up right now, based on what was put into place on Wednesday, it creates a lot of challenges. And Wayfair does have this a relative advantage because it's a marketplace. It doesn't create its own furniture, and it has an ability to surface products that are priced better or might be coming from countries that aren't tariffed. But if we're getting tariffs from every country, that edge goes away a little bit. And there's a lot of pressure on the consumer and in the category already. And if we're going to add another layer here, that just creates a really large challenge. Is
there any potential advantage for them, given that they are kind of viewed as being a little bit more of a lower price retailer? If economic conditions are going down, won't customers start to seek out those that can offer better prices?
Yeah, I think that's certainly true. And in general, I think Wayfair has been really well positioned, and they have plenty of competitive advantages across the board. Again, going back to that marketplace, the amount of SKUs that they have, the different types of vendors that they have coming from different regions. And I think what you have seen at Wayfair over the last couple of years is people have gone there as a place where you get relative better options in terms of pricing and better deals. And Wayfair has done a really good job. They've outgrown the category over the last few years and have taken share. And so that can certainly continue to play a factor if shoppers continue to be price conscious. But in our view, in the near term, just the headwinds from another layer of pricing increases in the space outweigh any of those competitive advantages, and that creates just too much uncertainty in our view right now in the near term.
Ygal, how does Wayfair handle inventory? Because if they're over inventoried and the consumer's stuck, then they're going to have to discount, right, to get them kind of on their website ready to go. Where do they sit right now?
Well, again, the advantage for Wayfair is that its vendors are the ones that are really responsible for pricing and managing inventory. Wayfair has plenty of logistical capabilities and helps their vendors manage that. But in terms of the impact to margins and the bottom line, Wayfair doesn't have the same type of exposure there that most retailers do, because they are a marketplace. They help their vendors, and their goal is to get their vendors the best amount of sales and be positioned have their inventory position in the best way to optimize all of that. But they don't have the same exposure there. That's a net benefit. So to us, the challenge for Wayfair and the call on the downgrade really just comes down to the top line and potentially a meaningful amount of lower sales and how that trickles down.
All right. Thanks a lot, Ygal. We appreciate it. Citi's Ygal Arounian, Director of Internet Equity Research, joining us there. All right. Coming up, investors continuing to pile into treasuries. We're going to discuss with Bill Campbell, Global Bond Portfolio Manager at DoubleLine, his call on the market. This is The Close on Bloomberg.
We've gone from free trade or world trade and globalization to this system which implies significant restrictions on trade in every direction and a step toward isolation for the United States.
And legendary investor Howard Marks speaking a little bit earlier right here on Bloomberg Television on a day where we're getting a big taste of what the market thinks of this new tariff regime and more importantly, a potential new economic regime. We were down 5% yesterday. Alex Steele, looks like we're down 5% right now on the major indices.
Yep, really brutal. Exactly that. NASDAQ, though, off the lows, down just 4.7%, but the VIX ticking up. Money moving. I did. I definitely did. And the money moving in to the Treasury market. Howard Marks also with Lisa talked more about the dollar. He said, look, if people don't like the dollar, they don't want to invest in the U.S., don't want to hold unlimited number of treasuries, and if we just make people mad, the fiscal situation is really complicated and kind of warning that out there.
Yeah, and we saw the volatility in the FX space over the last few days. Remember, at first everyone was selling the dollar. Interesting to see how people are positioned longer term with the CFTC data crossing the wire in just a few minutes. But now, of course, today you're seeing a bit of dollar strength. Yeah,
yesterday's action was really confusing. So let's get more on that. Our next guest says that risks around tariffs continue to cloud the outlook. Joining us is Bill Campbell, Global Bond Portfolio Manager at DoubleLine. You're the guy that does the macro, Bill. So can we just start on the dollar for a moment? How do you understand the dollar's price action? And is there going to be a real shift in how overseas investors look at that asset?
Well, thank you for having me. I think that yesterday's price action is something that really all investors should take note of. Over the past 2 decades, with low and negative interest rate policy across the globe, we saw trillions of dollars of foreign investment come into the United States. And really, with U.S. equity returns, private equity returns in the United States, you just had no other place for global investment really to find an area where they could have capital growth outside of the United States. And unfortunately, what we're seeing right now with the change in trade and tariff policy, as well as a change in geopolitical policy from the United States around the security guarantees, is maybe a rethink of, does that capital really need to sit in the United States? So I think what we saw yesterday and potentially what we're likely to see over the medium term is either a repatriation of that capital, of foreign investment flowing back out of the United States, or at least more dollar hedging and new capital maybe not flowing in. I think today's move is much more in line with the traditional dollar standard that we would have expected with a global economic shock. Today, we saw emerging markets hit the hardest, with China responding to, with retaliatory tariffs of their own. That obviously hits the global economic outlook, and capital is flowing, really to the safe haven asset of U.S. Treasuries in a knee-jerk reaction. Now, that's near term. Over the long term, I'm afraid the longer that these policies from the Trump administration remain in place that are aggressive, isolationist, the more that we're going to see foreign capital find other homes, the more we're going to see the potential for returns in international markets go up. And it puts the dollar at medium-term risk. And with this, one of the things this administration is trying to do is juice growth by bringing down the overall cost of capital in the United States. You've heard Scott Bessent talk about that. And if we don't have foreign savings flowing into the U.S., that's going to make that, objective or that goal very difficult.
So, I mean, but I understand that a lot of these short-term moves, we can't read too much into how it plays out long-term. But you put some of these day-to-day moves together and you do get a better sense of the trend. I'm not sure what the trend is with the dollar right now. A lot of people are betting on weakness. I see just as many people betting on further strength. Where does it go, Bill?
Well, I think you need to look at differentiation. So let's first break out the bucket that is working as expected. The currencies that are hanging in, with strength that we would expect in a period of economic uncertainty are the yen and Swiss franc. Mm-hmm. Those are, flight to safety currencies, and that makes sense to me. The one that is a little bit that may be bucking the trend this time around is the euro. Again, the euro's had a decade and a half of negative interest rate and low interest rate policy that has led to European capital flowing into the United States. And in a time of global economic uncertainty, there is the potential for that capital to be brought back home. In emerging markets, I think there's still a tie to China growth, and the economic uncertainty and volatility I would expect to manifest itself in weaker currencies, more like what we're seeing today. One other thing to just keep in mind, if the dollar continues to weaken with U.S. tariffs going higher, that actually increases their impact on their economic impact globally. The idea with a strong dollar and weakening currencies is that the currency weakness from an international perspective would offset some of the impact of that tariff. And if that doesn't happen, the feed through for growth economically has the potential to be even worse. Yeah. And the feed through to inflation domestically has the potential to be, more persistent or longer lasting.
And this is always a good time to kind of remind folks, too. I mean, we're still kind of at the early stages of this. Obviously, we've gotten the U.S. side of the equation. But as you saw this morning, Bill, with the announcement by China, this is a market that's still on edge for what the retaliation is going to be from other countries. We haven't heard from Europe yet, because that could be a big one. It's not clear when that's going to happen. But I assume over the next few days we will. How will the market take that if they retaliate in a similar magnitude that we saw from China?
Oh, I am extremely worried. The reaction would be negative and more in line with the price action that we've seen today. If we get similar responses from Europe that we got out of China, basically matching the U.S. policy, that would be clearly growth negative going forward. Now, on the other hand, I think we also need to consider what's happening with the news around Vietnam. Yeah. If we can get quick agreements on a bilateral basis, or maybe on a multilateral basis, where we have trade barriers globally brought lower, then that changes the economic picture materially. But unfortunately, we're kind of playing against the clock on this one. So I would encourage the administration and all global leaders to try to reach a new equilibrium and hopefully reach a place where we can pull back all global trade barriers, all tariffs in the short run, because the longer this lasts, the more the negative impact is going to be on growth, the more we're going to have at risk the labor market, the more we're going to have at risk asset prices.
Yeah, I mean, that's probably definitely not going to happen, Bill, from what we've heard from the administration. Does this move the dollar out of a global payment system on the margin in a more meaningful way?
So we've been writing about this potential, for multiple years now. Ever since the sanctions on Russia took them out of the global payment system. I think that we started to see small movements in that direction. What we've also seen is a lot of movement towards regional trade agreements. You're seeing Asia is kind of really leading the way in developing a strong network of regional trade and bilateral trade agreements and memorandums of understanding between their central banks to settle trade in their local currencies and basically removing the dollar from those settlements. I think the actions that we're seeing today are only going to increase that going forward. I do think that it will take time to play out, that we are talking about, a multi-year process. But the longer that this policy remains in place, the more at risk the dollar is of maybe not being replaced by a new single currency that's going to be the reserve currency and the standard for global trade and settlement, but a multipolar world where countries look at what is their balance of payments, or who do they trade with and who do they invest with, and then their FX reserves and the capital that their investors hold will much more closely reflect that rather than just a dollar-based investment portfolio.
So I have to ask you, Bill, I mean, the final question here, but kind of how does this market reset? I mean, it's obviously going to take some time if there is a deal for obviously these individual nations or maybe something a little bit more wholesale, but there's going to be probably a significant gap before we get there. What does repositioning look like for those folks that are either sitting on the sidelines or maybe potentially sitting on big losses right now?
Yeah, so I think ultimately we're going to see investors globally are going to hold a much larger piece of the of international fixed income and international equities in their portfolios. I think that the rewiring of global trade that's happening now is only going to continue and going to accelerate. We're going to see many countries using their fiscal space that they have available to them to try to build out their national security and defense efforts, which is kind of what we're seeing in Europe right now. That is going to increase the potential for earnings growth and then multiples growth in international stock markets.
Yeah.
So I think that ultimately this leads to a place where international investors and U.S. investors are going to be looking at, a much broader composition of markets and currencies in their portfolio, as compared to today, where the dollar and U.S. equities and U.S. investment really has held a major spot in investors' portfolios.
All right, great stuff, Bill. Got to leave it there. Bill Campbell, Global Bond Portfolio Manager over at DoubleLine, a focus on the cross-asset markets. And he doesn't actually cover that corporate space there, but it's kind of interesting to see. We're finally starting to see yields there start to spread out, and that includes on high-yield debt. I think the spreads on junk bonds now widening to a 16-month high, according to Bloomberg data. And there have been a lot of talk in the past sell-offs that we've had over the last few weeks here that we hadn't really seen that blowout in yields.
Right, and this chart we're looking at here is that global junk bond spreads really spiking on that tariff shock. We haven't seen that since 2020. What I want to do is go back and see if there's a way to filter out 2020, because that was so specific, and to then look at from other economic crises and what the actual reaction then was.
They should have a bug on the terminal where you can just do that. What I do now, I just put the chart up going back to,
and then you just like,
and then I look at the previous the time period prior to March 2020.
Because everything is going back to 2020.
Because everything's going back to 2020, and that really just shows just how extreme things are right now. You're seeing that as extremeness of course, in the equity space. You're seeing it in the fixed income and FX space. You're also seeing it in commodities. The Bloomberg Commodity Index that tracks all the major commodities now headed for its worst week since 2022, being dragged down heavily by what you're seeing there on your screen. Crude oil here in U.S., WTI crude at the bottom of your screen, Brent crude in London, both down on the day. And of course, on a weekly basis, you're looking at significant losses of 9 to 10%. Also extreme pain in some of the other commodity spaces as well. Some of the move in crude wasn't just about tariffs. It was also about that surprise announcement by OPEC. Rebecca Babin joins us right now, senior energy trader at CIBC Private Wealth, to talk a little bit more about that. And let's talk about kind of the 1-2 punch that we saw on oil. I mean, first you had, I guess, the shock of tariffs, so I don't know why everyone was shocked. And then you had, I guess, what was a more reasonable shock with OPEC coming out and saying that they were actually going to boost output by, what was it, about 2/3 more than what the market had expected?
Yeah, so it really was kind of that Mike Tyson moment for crude oil this week, where everybody's got a plan until they get punched in the face. And really kind of that tariff announcement, which I know you've hinted at should have been expected, but really wasn't priced into crude, was the first kind of hit. And then the bigger hit that I think really kind of has shaken many investors is the decision by OPEC to not only unwind their production cuts, so they decided not to pause in the face of market weakness, but to accelerate their unwinds. And really, this is a shift in policy. OPEC Plus has been operating under this guise of, we provide market stability, right? We're going to cut production when things are bad, and we may increase production if things become a spike, kind of this balancing kind of mechanism in the market. And what we're seeing and what investors are fearing is that that's not there anymore. They might not support the market on a major pullback, and they may be more aggressive bringing back supply. So both of those factors really kind of shook traders to the core, I think, over this last couple of days. And we are down, in excess of 10%. And it's really the place where I think what the question everyone's asking now is, what is the catalyst to buy this dip, right? So we're at 62 WTI. If we get into the high 50s, which is the strip is already pricing, do we see production come off? But what's the catalyst? And I think that question is unanswered, and the reason why it's really hard for the market to kind of find its footing at this point.
What's so interesting is that it's not a demand issue yet, because if you look at the curve, like we're still in backwardation, prices today are still more expensive than prices later, but that whole curve is re-rated downward. If I'm an oil producer, I'm looking at a 62 handle and I don't like it. What's going to be the knock-on effect?
Yeah, so I think the break-evens in the US have gotten much better. So they used to be kind of around 55. It's gravitating a little lower to the 50s because they've been so efficient. But I absolutely think they are capital disciplined, and they're going to see the uncertainty on the horizon. And I wouldn't be surprised, we're coming into earnings season, if we do see some of the producers start to say, hey, I'm scaling back. I'm going to take this slow. I'm going to reduce my production. And I think that's supportive to commodity. But at the same time, it's concerning because it hits on our economy. I mean, we are not a crude importer. We are a bigger exporter than we are importer. So that will have another on the economy. So I think the commentary from the producers in the upcoming quarter is going to be very cautious, and I think rightfully so.
Yeah, I mean, Harold Hamm told me that no one was going to drill below 80, so this has definitely got to hurt from that perspective because costs are actually really high. Steel, aluminum, copper, and then you also have labor. What do you think OPEC Plus response will be if we get to that 50 handle? Do they stay firm in putting more oil back into the market?
Great question, Alex. I think that's a huge question mark. I think if you'd asked me a week ago, I would have said they will absolutely stop on bringing back production, and they may even cut further. If we get into the 50s, I actually don't think that they come in and start cutting production aggressively as they've done in the past. They may pause their unwinds, aka not bring back additional production, but I don't think they're going to come in and say, hey, guess what? We're going to give you the market lollipop as they've done in the past and take, 500,000 to 1 million barrels off the market. So I think we can kind of put that aside for now. I think the other thing that we can consider on the supply side, though, is some of the supply risks that we were talking about last week that are now no longer in any narrative. Is I do think we could see supply from Russia decline if talks between Russia and Ukraine don't come to fruition. Trump may start to exert some of the pressure that he's threatened. And again, with Iran as well, right? There's been talk of maximum pressure, and it hasn't come to fruition. So we could see some of those supply risks, reemerge. But I don't think it'll make the market comfortable until we see hard data on how demand is responding to these tariffs.
I am curious, Rebecca. I only have time, I think, for one more question, but I kind of want to circle back to the consumer for a second because we started off the show talking about them. There's been a lot of talk about maybe how some of this pain does potentially have some benefits in the idea that if gasoline prices fall, heating and cooling prices potentially may also fall as a result of this. I know that's not a complete salve for some of the other pain, but do you anticipate that we could see a feed through into the finished products, or the refined products, if you will?
So that's a fair point. And I do think we will see some of that kind of lower cost into products help spur a little bit of demand. But the reality is the kind of density of how expensive crude is to how much we consume, the elasticity is much less than it used to be. So as those refined products get cheaper and the inputs are cheaper, we might see demand increase. I think the estimates I'm seeing are 70 to 80,000 barrels a day based on kind of lower cost, but it's not going to be significant enough to really move the needle. It's going to be kind of an afterthought.
All right, Rebecca, thanks a lot. We really appreciate it. Rebecca Babin, senior energy trader at CIBC Private Wealth. But Romain, to the broader point here, Brent has like 45% short positions right now. That's ramped up tremendously in just a few days.
Yeah, and I don't really understand how OPEC Plus makes these decisions, but I do wonder, did they take into account the potential of an economic drag from the tariffs, or do they just kind of do it independently?
They don't like cheaters. So Kazakhstan has been pumping above their production level. They also don't want other countries to do that. So like, guys, we're not going to subsidize you anymore. If you're in OPEC Plus, stick to the alliance, or else you're going to get these lower prices at the end of the day.
Yeah, and I mean, the drops that we're seeing on the day and on the week in the energy space are pretty dramatic. But I just also want to point out, and you see some of the numbers here, but also just want to point out some of the other pockets of the commodity space in that drop that we've seen, because it was like, the soft commodities, of course, got hit primarily because of the potential for retaliation, but also a lot of the industrial commodities that are sort of, the engines of our economy, if you will, aluminum, copper, nickel, which is still distorted, but huge drops on the day and on the week, 10% on copper, which, remember, we actually saw a rally there a few days ago as people thought that was actually going to benefit from all this.
Right. You still have the ARB going between LME and the COMEX, so U.S. and London-based copper prices. But nonetheless, that's really going to be a demand story at the end of the day. And taking a look at where we are here, I mean, just look at the SOX index, the semi-index. I mean, the superlatives for that are really tremendous. The SOX index, lowest since 2023, down for 7 straight weeks remain. Worst losing streak since 2002. And it's sort of right across the board around the lows. Can't seem to get up from that.
Yeah, the S&P off the lows of the day, but you still see there a 5.4% drop, matching roughly the drop that we saw yesterday. So a 10% drop over the last couple of days, back at that 5,100 level, well into correction territory. As we speak right now, only 18 S&P stocks are in the green, led largely by names like Nike, D.R. Horton, Lowe's, and Home Depot. Katie Nixon joins us right now as we continue to count you down to the closing bells. She's Executive Vice President and CIO for Wealth Management over at Northern Trust. All right, Katie, we talk about 2 days that I'm sure we're all going to remember. And I guess the big question becomes, is this just kind of a bit of a reset for the market as people digest the potential economic impact and then maybe reset next week when hopefully we get a little bit more clarity? Or is this kind of the start of a more prolonged downturn?
I mean, that's the question. And I don't think the answer is clear right now. A lot can happen over the next couple of days. We know that these announcements can be modified and walked back. But I think the sheer shock that you're seeing reflected across all the red on the screen that you've been showing is emblematic of a market that was not prepared for what came out on Wednesday afternoon. And until that becomes a little bit clearer in terms of the long-term implications, I'm not sure we can officially say that, this is a reset and we're going to build up from here. I think we're going to be in this period of uncertainty for quite a while, and that could mean more days like this. And it could also mean we'll get some news over the weekend and we'll have the opposite effect.
Yeah, potentially. And I guess the question, though, becomes then, Katie, particularly for your clients and just your general cohort here, what is the conversation that has to be had right now for those folks that are going to be taking a look at their portfolios over the weekend? Retirement money, a lot smaller, it's a lot smaller nest egg than what it was a week ago here. Is the conversation stay the course, you're 10, 20-year investors, or do you start to talk about a meaningful reallocation of that cash?
So, what we're saying is not stay the course, because stay the course feels like everything's going to be fine and let's just hunker down and let this storm pass. What we're saying more to our clients is confirm the course. So let's take this opportunity to make sure that you're right. So we start with asset allocation. Are you aligned with your asset allocation to your financial goals? If not, there's always a good time to reaffirm your asset allocation, even when risk assets are stressed. If you're not right with your asset allocation, now is the time to readjust. The second thing is, and it's really relative to my comment earlier, Romain, is we expect this period of uncertainty to persist for a while. So we want to make sure that our clients and all investors can sort of survive and thrive through a period of market volatility and uncertainty. And one of the ways that they can do that is making sure they have cash, highly liquid cash and high quality fixed income in a sort of portfolio reserve portfolio, they can use that to draw down, fund their goals, fund their lifestyle, live their life, and allow risk asset markets to eventually recover. We don't know when that recovery will happen. It could happen, as we just said, over the weekend with an announcement, or it may take longer. But what we do know from history is that they do recover. And so we want to make sure our clients are not necessarily forced to sell into a market downturn like this. And the last thing I'll say, and it's something that you've heard from many guests today, is, make sure you're diversified. We're seeing acute pain in U.S. technology. We're seeing acute pain across large cap S&P 500. We're seeing better performance out of non-U.S. markets. We're seeing better performance out of things like listed infrastructure. So make sure that you're diversified even within your risky asset portfolio, and that'll help you weather the storm.
Does that mean also go outside U.S.? I'm trying to understand if all that money that came into the U.S. for 10 years now needs to leave the U.S. in some capacity.
It really does, Alex, because, we've been so U.S. heavy, so U.S. centric for quite a long time. And it's been obvious why. This is where the earnings have been. This is where the growth has been. But with things slowing down in the U.S., with there being much more uncertainty around the outlook for some of these market leaders, I think you naturally gravitate to more undiscovered areas of the global equity landscape. And those undiscovered areas up until a couple of months ago really have been outside the U.S. They've been in Europe. They've been in Asia. That's where the expectations have been really low coming into this period, where the expectations in the U.S. were extremely high coming into this period of uncertainty. So yes, we are absolutely recommending to our clients to be a global investor, to take advantage of all the opportunities that are outside the U.S. And I'll say the last thing quickly is, I think you'll get more benefit from global diversification now than you have in the past, because these areas of the market may behave and act differently under this new tariff regime.
But if we wind up hitting all global growth because of it, or I guess, is that expectation mean that we won't see global growth suffer, that it'll be a very U.S.-centric story?
Not really. It's just a question of what's baked into prices and what's baked into expectations. And I think the slowdown that we're expecting to see in the U.S. is more acute than had been expected, and that has not been priced into the market. And I would say it's not even really priced in today. We've had a 10% correction. Of course, that feels very difficult and terrible. That is not a recessionary correction. So I don't think necessarily that markets have completely adjusted to the downside scenario of what could unfold in the U.S. if these tariffs do remain. However, I think because of valuations and expectations being so much lower abroad, even if we have a slowdown in growth in Europe and in Asia, you don't have as far to fall, frankly.
All right, Katie Nixon, Executive Vice President and CIO for the wealth management business at Northern Trust, counting us down to the closing bells on what is a wild week, probably a historical week, Alex. We should point out stocks right now heading back down towards session lows. Your low of the day on the S&P 500 was 5,072 and change. We're at 5,077. We talk about a correction territory for the S&P, bear market territory for the Russell, correction territory for the Dow. Yeah. Bear market territory for the transports. And of course, on a subsector basis, it's worse. You're talking 20-30% declines on some of these sectors.
And Morgan Stanley, just this morning, was talking about a level of support of 5,100 to 5,200, blew past that one. So now you're looking at 5,500 becoming more resistance level at that time. And that's a whole different lineup at the end of the day. And again, I go to the semis, Romaine. Yeah. The superlatives for the semis are unbelievable.
Absolutely. And we talk about this idea of what is an orderly sell-off. We should point out 14 stocks in the S&P higher. This is going to be the broadest based sell-off effectively that we've had, at least since the whole carry trade blow up of last August. But maybe even prior to that, you have to go back to 2022 when we had some of those economic scares.
And which can make the argument, is that a good thing? In that, are we finally seeing the kind of washout that maybe sets us up for a little bit of a rebound? Julian Emanuel looking for turnaround Tuesday. Thinks Monday will be bad, but thinks Tuesday might not be. And the VIX really picking up too, which leads a little bit credence to that idea. Yeah. Correlations pick up. There you go.
And we should point out too, Team Surveillance is going to have a special edition on Sunday afternoon starting at 5 p.m. Eastern time to set you up for that Monday trade. But right now we break down the Friday trade with our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic here with Alex Steele, taking you through the global closing bell. A global simulcast starts right now. Scarlet Fu back from vacation. Carol Massar and Tim Stenovic still here in what's been a very relatively exhausting week for everyone involved as we welcome our audiences across our Bloomberg platforms, including our partnership with YouTube with stocks. Carol Massar now back at the lows of the day. The S&P down 6%.
Yeah, we were looking really closely to see whether or not we saw any kind of buying into the close here. But as you mentioned, Romain, definitely taking another leg down. So we're looking at the worst week for stocks since March of 2020, back smack in the middle of COVID and the beginning of COVID. And we've got the S&P losing something like $5.2 trillion worth of value, market value this week. So yeah, definitely one for a major, major risk off. Really coming off of course, President Trump's tariffs.
Look, not a good thing ever to talk about comparisons with the height of the sell-off during or ahead of the COVID pandemic, but we are seeing the worst day on the S&P 500 since March 16th of 2020, when that index dropped close to 12%. But we've given up our gains on the S&P 500 for going back almost a year. It's right now trading at a level that was last seen back in May of 2024.
Yeah, and let's not forget, too, it's Friday, and who knows what's going to happen over the weekend. People don't necessarily want to be long over the weekend because there could be a whole lot of pronouncements. There could be some deals announced, and you don't want to be exposed to that. Having said all that, the rally in treasuries, the safe haven of choice, it's really lost a lot of steam here.
All right, we are getting the closing bells here in New York. I do want to point out, too, equity option volume from both stocks and indices looks like it has actually hit a record high. It'll take a little bit while for us to get the final numbers on that. But remember, yesterday was the second most active day in the equity options market on record. And it looks like today has surpassed that to overtake a record that was set back a few years ago. The Dow Jones Industrial Average that you're looking at on your screen right now, closing out the day lower by 5.5%, a drop of 2,232 points, now settling at 38,313. The S&P 500 below 5,100, a drop of more than 300 points or 6%. You add that to the 5% from yesterday, and you can just do the easy math yourself. The NASDAQ Composite down 1,000 points or about 6% as well, and the Russell 2000 down 83 points or 4.4%.
Yeah, let's not forget, too, we saw credit fear gauges soaring, so a lot of nervousness in this market. We understand why. I look at the S&P 500, guys. Almost every name is lower. 489 names losing ground, only 14 gainers. And again, S&P 500 ending the week down 9.1%, biggest decline since March of 2020.
And we should just point out the S&P, deeper into that correction territory. The NASDAQ 100, it is official. It is in a bear market, down more than 20% from its all-time high score.
So it should be no surprise then that when you look at the IMAB, it is a sea of red. Every single industry group in the S&P down at least 4.5%. If I were to look at it on a 24-group basis, there is one group that did buck the declines: consumer durables and apparel. And that's tied to Vietnam, of course, because if Vietnam actually drops the tariffs against the U.S. and Trump, of course, ameliorates the situation with Vietnam, that could be good news or less bad news for companies that rely on manufacturing in that country.
Well, that's a great setup for me because Lululemon is one of those names that could certainly benefit if we see a backing off of those tariffs against Vietnam. Lululemon, your second best name in the NASDAQ 100 today, guys, up about 3%. Earlier in the session, it was up more than 6%. But still a 3% gain after losing almost 10% in yesterday's trade. So as Scarlett mentioned, those names, those companies that have large manufacturing operations over in Vietnam, including Nike, including Lululemon, soaring after the president said that he had a really good call with that country's leaders. So that certainly stand out. And then I got to talk about the home builders because they also popped in today's trade. D.R. Horton among them, one of the top gainers in the S&P 500, finishing up with about a 4.5% gain here. And this is, of course, what's going on in the rates market, the U.S. rates markets. Falling rates, then you expect that to maybe make it cheaper for home buyers or folks who would like to be buying homes out there. So that was good for the home builders.
So many stocks in the red today. I just had to go with indexes. The KBW Bank Index follows banks, of course, down 6.6% today. In fact, banks had their biggest two-day drop going back to March of 2020. This after China escalated its trade war with the U.S. Capital One fell 8.2%, as did Bank of New York Mellon. JP Morgan Chase fell more than 8%. State Street down 8%. Goldman Sachs down 7.9%. Citigroup down 7.8%. Jason Goldberg over at Barclays reminded everyone that even though banks don't have direct exposure at the same level that other industries do to a global trade war. They have exposure to the industries that are affected by this. Of course, concerns about the economy, interest rate levels as well, also weighing on banks. Yeah.
Well, we should point out, too, though, there is some direct exposure there when it comes to capital markets activity,
Yes.
Tim. You saw the IPOs that were put on pause today. Klarna, Mountain, Chime, StubHub, eToro, just to name a few. Not a single sale in the corporate debt markets today or yesterday. And then you top that off, and you talk about just the general deal-making activity. There were several M&A deals that were also put on ice for right now.
Yeah, the tightening of
And those
financial
are fees
conditions
lost.
that we've seen just in such a short period of time
Yeah.
has been pretty remarkable. Also, keep an eye on U.S. stocks or Chinese stocks that are traded here in the U.S. with the NASDAQ Golden Dragon Index down close to 9% today. This after Beijing retaliated against the tariffs with an extra 34% levy on all imports from the U.S. Shares of the Golden Dragon Index falling by close to 9% today. Still, analysts said that retaliation came sooner and stronger than expected, and it raises concerns about an escalating trade war, even at this point.
All right, let's go to the bond market, guys. Where do you go when you need safety? The bond market. But even the moves, I feel, were somewhat tame in relation to the massive sell-off that we saw within the stock market. So you got the 2-year down by about 3 basis points. You got the 10-year down by about the same. But on a weekly basis, you're just looking at 13 basis points lower for the 2-year and about 10 basis points lower for the 10-year. So it's still like a moderation of buying that we saw. Nonetheless, the 10-year around 4, dipping below 4% at one point, definitely significant. Can I honorable mention commodities for a sec? Because we had a huge sell-off in the commodity market, particularly when it comes to crude. I mean, down a whopping like 6% in a day. 5 days, oil in the U.S. is down a full 10 percentage points.
It's kind of interesting, too. I mean, I was keeping an eye on flows, and some of this, of course, only really goes through Thursday. But we talk about record inflows this week into gold ETFs. Significant inflows, at least on a relative basis, almost record level inflows into European ETFs relative to U.S. ETFs here, and actually a lot of inflows into EM, and of course a lot of outflows in the U.S. And that great note out by Michael Hartnett this morning, in his words, actually telling people that maybe you short things right now as we enter a new secular bear market. Remember, in his view, it wasn't just about tariffs; it was also about the impact of Doge, and of course about the impact of DeepSeek back in January.
Yeah, to that point, just looking at flows, one-day flows. So this would be for yesterday. The Qs and Bill, which tracks short-term treasuries, saw the most inflows, but the volumes at which they saw inflows was minimal compared to about $4.5 billion coming out of SPY, which is the trader vehicle for the S&P 500.
You know, two things top of mind. We talked with our Gina Martin Adams. My concern is if the U.S., if this trade war stays around for a long time and it becomes a recession here in the United States, what happens in the U.S., it could ultimately, we're going to impact the whole world, right? If we see a global trade war, it's not going to be good for the global economy. It's something we talked about with Gina Martin Adams. The other thing is everybody says the caveat, what if President Trump changes his mind next week, in a month, or what have you? How long these tariffs last really determine what happens from here.
Well, walking it forward, though, too, have we seen capitulation, guys, when we talk about how many decliners are there versus advancing stocks within the S&P, and then that pickup in cross-asset volatility and the pickup in the VIX? Are we finally clearing some positioning out, which would stabilize the equity market?
I don't know. I mean, we spoke to some folks earlier in the session today, early in our program, who said 44.50 is what he expects on the S&P 500. So he sees further room to move lower.
All I can tell you is I'm ready for my pizza and wine, everybody. All right, that is a wrap. Have a good weekend. I don't know. Have you looked at your I've looked at my 401k.
I will say, interesting day for Scarlett to come back from vacation.
All right, guys, have a good and safe weekend. Be sure to check out the surveillance special on Sunday. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place on Monday.
And we continue our coverage right here on Bloomberg Television. Scarlett, another superlative that we should really point out was the volume. Volume was at a record today. When you go across the tapes, A, B, and C, 26 billion shares swapping hands. At no point since that index has existed have we seen that type of volume in a single day.
Yeah, pretty incredible. And it speaks to the idea that no one knows what's going to happen, including this weekend. So why stick around? You can always come back in if you need to next week.
Well, you saw that in the fact that only about 14 stocks in the S&P 500 managed to actually rise today. Everything else was down. Everything else that mattered. A 6% drop for the S&P 500. You add that to the 5+% decline yesterday, and we are in uncharted waters. Some of the worst days that we've seen going back to the onset of the pandemic. Some of the worst worst weeks that we've seen going back to the onset of the pandemic. The S&P back in correction territory, the Russell 2000 in bear market territory, the CBOE VIX index at one point spiked to the highest level since the carry trade blow up back in August, and your 2-year yield doesn't look like much on the day, but we're talking about a 30 basis point drop in that yield just over the last 5 days. You flip up the board and you look at some of the sectors here. Airlines really took it on the chin here, now entering bear market territory there. Remember, we do get earnings out of Delta next Wednesday, so it'll be interesting. Next Friday, we also start to get earnings out of the bank stocks, including names like Morgan Stanley and Wells Fargo. That index, of course, took it on the chin. NYMEX crude down 7% on the day, and home builders, one of the few bright spots on the day, maybe because people are betting on a further drop in rates.
Maybe. Let's take a look at another bright spot, which is a couple of companies that really rely on manufacturing in Vietnam. Of course, they turned around after President Trump said he had a good conversation with the leader of Vietnam, perhaps indicating that he'll backtrack on some of those tariffs on that country. Nike, which gets about half of its apparel made in Vietnam, gaining 3% on the day. Lululemon, the yoga wear company, relies on Vietnam for about 40% of its goods. That stock up of more than 3% as well. Victoria's Secret gaining 14%, erasing a 7.5% drop. And Wayfair, the home furnishings company, lost as much as 19% in trading today before turning around. In fact, it was briefly halted from trading because of volatility. Romain?
All right, let's keep it going here with Lori Calvasina, head of U.S. equity strategy over at RBC Capital Markets, as we assess the damage done here on this week, Lori, and try to look ahead to maybe what next week might bring. I am curious as to what you read into the sentiment behind the drop in prices that we saw over the last couple of days in equity markets.
Well, first of all, thanks for having me, Romain. And look, I think it depends on whether you're talking about yesterday, whether you're talking about today. One of the points of conversation that was coming across, kind of my desk and my email today with some of my colleagues internally was about how, things like the VIX, kind of really moved up, things like the TDEX, things like the CDEX, or SDEX rather. So it looked like, in sort of that corner of the options market, we were finally getting a bit more fear. I wouldn't quite call it panic, but it felt like, something bordering that versus what we had yesterday was pretty orderly. We weren't seeing as much stress in things like the TDEX and the SDEX. If I kind of rewind and look back at the beginning of the week, I think this market wanted to bottom around 10% from the February peak. And as I think back over the last few weeks, a lot of investors I spoke with, especially people in sort of the hedge fund community, thought there was still a Trump put. I kind of debated that with them a bit, but, really wanted to buy the dip and wasn't quite sure where that put would be, where that low would be. But you could see the market defending that mid-March low throughout the week. And the Rose Garden announcement just did not permit that. So I think you've had some people, sort of kind of making sense of that, frankly, and kind of stripping away that idea of a Fed put. And I think the idea that the administration would be willing to incur short-term damage to the economy, short-term damage to the stock market, that still just wasn't really sinking in at the beginning of the week, and I think it is now.
We're talking about an S&P now, down 17% from that all-time high, Lori. We should also point out this is a global sell-off. The MSCI All-World Country Index down 15% from its all-time high as well. And it raises the question as to whether there is a switch to be flipped. Because I know there are a lot of people that talk about the Trump put, and at this point, maybe that put is he backs off on the tariffs. Maybe there's some negotiation. But I do wonder if so much damage has been done, how long would it even take us to claw back to where we were 7 or 8 weeks ago?
Look, I think it's a great question, Romain. I mean, I think as some of the price action showed you today, if you kind of see hints of progress, right, on certain specific things, there are individual stocks and corners of the market that can recover from that, right? And we all know, we've lived through this for many decades, right? Like when you have big drops like this, on the other side, rebounds can be fast and furious. And so we've, sort of seen people, talking about that in recent weeks, kind of being unwilling, to get too bearish because of that rebound impact. But I did say, when we cut our target and we put that note out this morning, we'd been signaling we'd probably do that for quite some time if we broke below the mid-March low. So we had to go ahead and kind of pull the Band-Aid off on that. But, we did change one of our assumptions about the political backdrop for stocks. And, as recently as a couple weeks ago, when we cut our target down to 6,200 the first time, we went to 5,550 today. But when we made that first cut, we left in an assumption that we would see the return of a business-friendly environment to the stock market later this year. Sort of baking in the typical gain that you get when Republicans control the White House and both chambers of Congress. We took that out this morning, and we basically replaced that with an assumption that we needed to look back to 2018 when we had a down 6% year. We had a 20% drawdown. That was, of course, the year of the first China trade war, and we had frothy sentiment and positioning to start the year. You had concerns about Fed policy error. Not exactly the same this time around. I don't think a ton of people are worried about the Fed, but we do think that there's a lot of, symmetry between that year and this year.
Interesting that you're using 2018 as an analog here. You had mentioned earlier that the Trump administration has warned and is okay with enduring the pain in the short term in order to incur those long-term benefits of bringing manufacturing back to the U.S. His team had predicted a recovery in the second half, even before the April 2nd announcements. Is that still on the table, Lori, for you?
Look, so we've got 55.50 as our year-end target. That's how we think of our target, as a kind of year-end bogey, not sort of an intra-year type number. And so, that does put us up a bit from here. We do think in the interim we could go lower. So a typical growth scare, and that's what we seem to be in the middle of right now. Maybe it'll end up being a recession pricing, we'll see. But that should bottom out, kind of in the 4,900 to 5,300 range. We're obviously well below that 5,300 now. But if you look at kind of the idea of a rebound, that's certainly supported by our sentiment work. AAII net bulls are as bad as the lows of 2022. They are as bad as the lows of the 1991 recession, and they are as bad as the depths of the financial crisis. That is stunning. We've been seeing that on that data for quite some time. That's the only one of our models, that's still giving us a really strong bullish signal at this point in time.
Okay, so your base case does not seem to include a recession. What is your worst case scenario in terms of the target for the S&P 500?
So, I think at this point, Scarlett, I think you want to look at recession pricing. And if we were to see sort of a typical recession drawdown, you would go back to the February peak and you would look at a median or average drop of about 27 or 32%. And if I'm remembering my math correctly, that takes us to about 4,200 to 4,500 on the S&P. We've heard other forecasters talk about similar numbers coming, from different approaches. But for me, that would probably be the worst case scenario right now. The base case for me is still that we have a growth scare, something similar to 2010, 2011, 2015, 16, 2018. Those were all fears of a recession or a major crisis where really we got to the brink and we saw a true panic come back into markets, but we didn't price in a full recession because something happened to convince markets that was not at hand. So that's what we're modeling now. I would say the other thing we're modeling, Scarlett, is more of a stagflationary scenario. So we've baked in inflation in the upper threes, a couple of cuts from the Fed. And we've also baked in like 0.5% on GDP in real terms in terms of the full year annual gain. So we've stressed the model pretty sharply, and we can still kind of get to that 55.50 number. Though, frankly, some of our modeling is a bit more pessimistic than that if we're just looking at the economy or we're just looking at our valuation work.
All right, Lori, thank you so much for sharing your perspective here. Lori Calvasina is head of U.S. equity strategy over at RBC Capital Markets. Clearly, Trump's tariffs are reverberating not just here, but globally as recession worries engulf global Wall Street. Fed Chair Jay Powell warning that the economic impact of new tariffs is likely to be significantly larger than expected. Joining us now, I'm pleased to say, is Raghuram Rajan. He is a professor of finance at the University of Chicago Booth School of Business. He's also the former governor of the Reserve Bank of India. Raghuram, thank you so much for joining us. Lori Calvasina was just talking about stagflation and how that was kind of the thinking last week. People were talking about that. No one had really, maybe at the extreme, talked about recession. Increasingly, they're now talking about recession. What is your base case? Is it a recession and a global recession at that, or is it something less?
Well, I think the probabilities are flirting with 50% right now for recession. Think of tariffs as taking, for every percentage point increase in tariffs, a rule of thumb is you get 0.1 percentage points of growth, right? So we were, in a 2% growth economy, maybe 2.5%, and you're taking off 2% off that with a 20% increase in tariffs. So really, we're talking about 0 to 0.5% growth, given the tariff increases that have taken place. Of course, as we've discussed, there may be some drawback on those tariffs as negotiations take place. Mm-hmm. And similarly, on inflation, you have to add another 2 percentage points to inflation because the rule of thumb is 0.1% increase in inflation as you have 1 percentage point increase in tariffs. So we're talking about, 4.5% to 5% inflation by the end of the year. So all this means the Fed can't really come in unless growth plummets. And we are going to see some shrinkage in growth. I think the 1.5% that investment banks were talking about before the announcement of the tariffs has gone much bleaker at this point.
I think back to what President Trump said today, which is my policies will never change. He also urged Jay Powell to cut interest rates, saying it's the perfect time for that. Do you think Powell's in danger of being demoted from Fed chair? And if so, is there some kind of Fed put as a result?
I think it would be a tremendous blow to financial markets if the Fed chairman is removed. All credibility associated with the Fed would vanish in a moment. A lot of people are still confident that the Fed is going to continue as is. Chairman Powell is protected, and he will take the right policies going forward. If he's removed, I think there will be a lot more panic on financial markets. I hope that doesn't happen.
When you look to this administration, I am curious as to who you look to as being sort of the guiding light when it comes to economic policy, and for that matter, maybe the potential for some sort of, rescue, for lack of a better word, from where we're at right now.
Well, I think this administration is run by essentially one person. It's President Trump. And unfortunately, whatever advice he's getting is reaffirming his natural instincts, which a lot of people have commented on right from the 1980s, that he believes tariffs are in fact good, and that in the medium term, it will create a lot more jobs domestically. I think most economists, including me, are skeptical about them creating jobs in the medium term, but we are almost sure that in the short term, there's going to be a lot of pain. I think Gregory Mankiw from Harvard University said it right. He was the chief economic chairman of the Council of Economic Advisors to President Bush. He said it's short-term pain in order to get long-term pain.
Is there a sense, though, that at this stage, that long-term gain can actually be done? And I ask because we had on Bloomberg television a little bit earlier, the head of the Council of Economic Advisors was kind of making this case. Look, that once you get to, the budget process and tax cuts and some of these other proposals that are out there, that somehow that ends up becoming the salve, that provides enough juice for the economy to blunt, if not erase, the negative impact from tariffs. You're an economist. Is that how it works?
Certainly some deregulation, some lower taxes for businesses can help elevate spirits. But tariffs of this kind, this is, remember, the highest level since 1909. They do a lot of damage to the existing supply chains. We've had global supply chains like never before, and those are going to be interrupted. The belief is somehow that we will get jobs back into the United States over time. But think about what kinds of jobs are going to come back to the United States. They're jobs where you don't need much labor because labor is costly in the United States. So we're talking about much more capital-intensive production. That's not what the administration wants. It wants more jobs for high school educated people, for moderately educated people, because those are in their support base. That's not going to happen. So I'm not sure what we're talking about when we're talking about medium to long-term gain. We have disrupted a situation where we had one of the strongest U.S. economies relative to other industrial economies in memory. The U.S. came out of the pandemic much better than everybody else.
Yeah.
And now with 4% unemployment, we're trying an economic experiment to do what? To get less unemployment than 4%? That's hard.
Well, you referred to that U.S. exceptionalism. I think about Howard Marks of Oaktree, who was on Bloomberg television earlier, Raghuram, and he was saying that the U.S. has long been a place for global investors who are seeking reliable returns. They want predictable outcomes. They want a strong rule of law. To what extent do they still have that in the U.S., or are both of those diminishing?
Well, I think there's been a lot of uncertainty about policy created recently. And that's why I said if you mess with the Fed, that makes it even more uncertain for global investors, because that brings inflation into play in a much bigger way than if you left the Fed alone. But I think there is worry across the board. Some of the people in the administration are saying, well, that may play in our favor because we'll get less investment, financial investment into the United States. The dollar will depreciate, allowing the U.S. to export more. But it comes at a serious cost, because you diminish the attractiveness of U.S. securities. And remember, the U.S. is running a large fiscal deficit, which needs all the funding it can get from across the world.
I do want to get your thoughts before we leave, Professor, about the new world order, if you will, if that is indeed where we are or where we're going. There's been a lot of talk about the lack of influence that the U.S. is sort of putting itself at the position in. The idea that there's trust is being eroded and that countries, whether it's our North American partners or our European partners, are going to seek out maybe a little bit more stability. I don't know from who. I don't know if that becomes China or someone else. But do you see that really unfolding? Or is the dominance of this U.S. economy and the clout that the United States has had, basically going back to the 1940s, is that going to be enough to maybe be the magnet that brings everyone back?
Well, it can still carry on for some time. The U.S. is, as you said, the biggest economy. It's been the most favored economy in terms of capital inflows, et cetera. That will continue because it's not obvious there are alternative places so readily available. But I think the search for alternatives is on. And once the search is on, people will find alternatives, perhaps in regional groupings, maybe around China, though I suspect the automatic rush to China is not going to happen. It's going to be more a measured, okay, we find it hard to trade with the U.S. Who else can we trade with? And so, a country like India is going to look to ASEAN. It's going to look to Japan. It may even mend its relationships with China and look to trade more with China. So every country is thinking in this way at this point. Yeah. And of course, the U.S. is still big and strong, but it is eroding it.
Absolutely. Professor, I have to leave it there. Always a great conversation. Raghuram Rajan, Professor of Finance over at the University of Chicago Booth School of Business, former Reserve Bank of India governor. And I do just want to point out for our viewers, Scarlett, we are seeing futures continuing to deteriorate, now down about a 0.5 percentage point from where we closed on the day. We also got settlement on the VIX closing right around the highs of the day, 45.31.
All right, we'll continue to keep an eye on those futures. In the meantime, President Trump's tariffs spurring concerns around American manufacturing capacity, supply chains, and of course, a factory labor crunch as well. So joining us now to discuss all of this is Pat Weiler. Pat is president and CEO of Weiler. His company produces equipment for major OEM manufacturers. And Pat, thank you for joining us today. I know over the last 2 decades or so, you have grown your company into a major manufacturer of multiple product lines for the paving industry in particular. What do these tariffs mean for your business, for your costs?
Well, certainly our costs will be increasing for anything that we import and probably steel as well, the way it sounds. We're a highly vertically integrated company, so we don't do a lot of importing of whole goods or large components at this point. So we're probably a little blessed for that. So we'll probably have a little better advantage than a lot of people. I think we'll be fine. We'll be able to price on our price increases due to the tariffs. It's just whether our customers decide not to buy because of the increased pricing and decide to wait a year or two before they purchase a replacement piece of equipment.
Right. So there's uncertainty when it's tied to that. I'm curious, given the president's stated goal to bring manufacturing back into the U.S., do these tariffs encourage you to do that? Would you set up more manufacturing capability in the U.S. because of these tariffs?
Well, certainly not today, because it's too much chaos, and chaos doesn't lend to very much investment. We need to watch this thing settle down a little bit. Obviously, building new plants and adding capacity and all that type of stuff takes cash, which is available. There's a lot of money in the country right now, but it takes time to build those buildings, and then you have to hope to get the employees. We're okay hiring employees, but if you're going to do much growth, we're going to have more people available to fill those positions.
I am curious, Pat. I mean, you've been in this business overall for several decades, so you've had a chance to see various economic cycles. When you start to see softness in the economy and the decisions that your potential clients for your current business would make here, do they effectively not make those purchases at all, or is it a deferment, meaning, okay, you lose out on that sale today, but maybe they're back to you 6 months from now?
It all depends on the downstream economics, right? So they're going to have to pay more for the equipment, which that's fine if they can use the equipment. So they're going to have to increase the bidding that they're doing to do a new highway or a parking lot or whatever. So as long as they can get those increased costs passed down to the ultimate supply vendor, they'll be fine. So will the parking lot people spend more money to get a parking lot replaced? Will the subdivisions be there to build more roads?
Mm-hmm.
Will the interstate highway system fund, put more money into building effectively less miles, right? Because miles cost more to put in, so it takes more money to repave a mile of road. So it all depends on ultimately what the consumer is willing to spend.
I am curious as to what business was like prior to all of the tariff news. I mean, which kind of goes back to early February, maybe late January. Were you seeing any sort of shift in potential customer activity then, or is all this kind of just unfolding now?
There's a lot of concern in the paving industry about where we're going with the tariffs. And again, ultimately, it's what is the consumer going to be able to spend? Is a dentist, for example, is he going to invest in a new parking lot for his business? Is he going to repave that parking lot to spiff it up? He may wait 2-3 years until this thing settles down before he decides to do that. Let a few potholes in his parking lot and hope his customers don't mind that, right? So it's the instability that we're all worried about for the people that ultimately write the checks for this equipment to be put to work.
All right, Pat, great insights, and we really do wish you all the best, and we're going to check back with you probably in a few weeks, see how things are going. Pat Weiler there is the president and CEO of the industrial parts supplier Weiler, which has a big focus on paving. We talk about the potential economic fallout from what the U.S. is doing, but there's also the potential fallout from what our trading partners are doing in return. China has announced its retaliation against U.S. tariffs, announcing a 34% levy on American imports starting April 10th. It's also restricting exports of 7 types of rare earths, also halting imports of poultry products from 2 American companies. Daniel Tannebaum joins us right now. He's a partner over at the law firm Oliver Wyman, and he says that there is no guarantee that China will rapidly reverse course on these measures, even if an agreement is reached. Dan joins us right now. Great to see you, Daniel. Why wouldn't they reverse it? I mean, this is the art of the deal, right? I mean, we do something, they do something. At some point, they all sit down and hash it all out. Are we past that already?
I don't know if we're past it, but some of the things they did today, they put 7 more minerals on a list of things that now America can't get. Minerals that they're almost the world's solo provider in. Mm-hmm. So they have some leverage that I don't think they would so quickly give up, especially as the U.S. is trying to secure additional mineral rights around the world. These are things that cannot be sourced from any other part of the planet, and they know that.
So what is, from China's perspective, what would the negotiating angle be? What, just get rid of the tariffs and we'll go back to normal?
Well, I think that is a bit of the question. Remember, this tariff bit with China began in Trump 1.0.
Yeah.
They learned from the first Trump term during the last Biden administration, creating the unreliable entity list where they made it harder for American businesses to operate, creating their own export controls. So I don't know if we know enough of a steady state where China has a view towards what they're going to pull back, but they haven't had a track record of going up to the line only to walk back things like kicking out the TikTok ban, for instance. Mm-hmm. Like, they have made these decisions and held to them for periods of time.
So in that way, they're predictable in a way that the Trump administration is not.
I think that's right.
Yeah.
So having said all that, you have pointed out that in the run-up to the April 2nd tariff announcement, China, South Korea, and Japan have announced that they would band together on American tariffs. Talk us through that and what it looks like right now and what it might look like as time goes on.
Now, we don't know what that'll actually look like in reality, but the fact that they made a joint announcement for countries that haven't gotten on universally in a lot of respects says something. So President Trump is bringing people together, but not in a way that's really helpful to Americans and American consumers.
What does that mean for how the U.S. proceeds? I know that President Trump has said he's not negotiating with any country, but if we look at what happened with Vietnam and the way that shares of Lululemon or Nike are rising because he had a good conversation with Vietnam's leader and perhaps people are thinking that he might backtrack, where does that leave us?
I mean, it does seem like a country-by-country strategy at this point. And looking at those boards of tariffs from the Rose Garden announcement, there's a lot of countries that are on that list that allegedly are coming into the administration trying to talk deals. I don't think there's deals being done in block form. I think it really is a bilateral discussion like what we saw with Vietnam earlier, but it does signal an openness to try and negotiate in some form or another.
Yeah, I chuckled a little bit earlier when I saw that whole alliance of South Korea, Japan, and China, and I thought, oh, okay, well, that's interesting. We talk about politics making strange bedfellows, and it gets to this idea of a reshaping, and we've talked about this before. before on the program about the reshaping of the global world order. Is China really in a position to maybe be the focal point of that, or is that just kind of wishful thinking?
Well, China has been saying in a number of events for the last few weeks, we are the stabilizing force in the world and America is the disruptor. They said that to the group of American CEOs that were in China last week.
Yeah.
And it is kind of hard to argue with that logic at this point, given everything we've seen over the last few weeks. How much China really stands to benefit on this. They certainly are looking to expand soft power in the void of USAID pullback across the world. We know there's Chinese efforts in Myanmar in the wake of the earthquake. So it is unclear how much they will benefit, how many more deals or alliances may be struck. But they look a lot more stable than the U.S. does right now.
I am curious, too. And you also mentioned TikTok, which we were supposed to have a deadline this weekend for some sort of sale to take place. President Trump came out basically offering a 75-day extension. There's reporting now by the Associated Press. This is from the Associated Press, citing people familiar with the situation, that China scuttled that deal, that they were ready to make that deal. But as soon as the tariffs were announced, apparently they called Washington and said, this ain't happening as long as these tariffs are in place. Does TikTok actually end up becoming kind of the hot potato in the middle of all this? I don't know how valuable that is, but a lot of people seem to be thinking that this could be one of the main negotiating points.
It is a company that certainly has taken an outsized view in American media and American politics over the last few years. I think it is another element of negotiations between the U.S. and China. I don't think it's any more important. It's just more an annoyance that China can really throw a spanner in the works for the U.S. that are trying to get legislation that was passed on a bipartisan basis actually finalized.
You talked about how Xi Jinping made the point that we are stable. You can predict what you're going to get when you come to China, to an audience that included the likes of Apple CEO, which does rely quite a bit on manufacturing inside China. What does the China response mean for a company like Apple that has really put its bet on this part of Asia?
Well, at this point, it's just words. Let's remember, this is also a government that had held in prison for 2 years Chinese employees of an American business in China. So, a lot of this is, what do the actions look like to actually prove that stability and that business friendliness going forward? I don't think we've necessarily seen that yet.
How are you what are your clients saying to you right now in terms of the questions they have, and how do you go about answering that? Because things are changing on a minute-by-minute basis.
So we actually have built a tool that maps supply chain, for instance. It maps it from a critical mineral standpoint, from a raw material standpoint to look for concentration risk. It looks at tariff exposure. So we have a lot of companies that are inputting their data into this to really understand where are we most exposed. But it is difficult to chart a path forward when tariffs were applied broadly and could change, like we saw with the discussion with Vietnam, where tariffs that were significant, above 40%, could be pulled back. So it is hard to make a decision, but we're having people really understand exposure right now, above all else, to potentially think of where might a move need to be made.
And you talk about the rare earths and some of those. A lot of these names I never even heard of, like, terbium and a few others here. But you talk about the dependence that a lot of manufacturers in the U.S., but that are based here in the U.S., have on those minerals. If they're not going to get them from China, and there is no other reliable source to get them, at least in mass, what happens? We just don't make EVs, we don't make batteries, we don't make these things?
Where this is going to get really entertaining for a sanctions person like me is we're going to end up buying them through third countries, like Russia's done through third countries to buy things that they've been banned from getting. That's likely what could end up happening.
That adds cost, doesn't it?
It does add cost. It's also on the wrong side of another country's law, where the U.S. has tried to push their sanctions in a way where it doesn't want certain countries to buy things that they've banned.
One line. Sorry. I love talking to Daniel, so we're just going to go a little longer here. I do have to ask you about all this hullabaloo over Greenland, which also, to a certain extent, is also about natural resources here. You laugh. Is this? Should I not take that seriously?
Look, everything he said in the campaign, he seems to be trying to tick off the list on. I do suspect there will be a closer military alliance between Greenland and the U.S. There used to be far more U.S. military presence on the ground. There's now one U.S. base on the ground that the vice president briefly visited last week. Well, I don't think America is taking over Greenland. As we've seen in other countries, people don't want to be invaded generally. And that's kind of what you're threatening at this point. So I do think there will be a closer military alliance. A deal will be struck to expand military operations on the ground. I don't think it's going to have kind of the stars and stripes flying anytime soon.
People don't want to be invaded. I'm unclear how many Americans want to do the
put that
invading
banner
as well.
right at the bottom there.
Yeah.
So
Dan Tannebaum, thank you
headline
so
of the
much.
day.
Partner and global anti-financial crime practice leader over at Oliver Wyman. All right, just a recap here of where things stand with markets. Romain, you mentioned that futures indicate we're still going to head lower, but of course there's a long way to go over this weekend.
Yeah.
This is what happened with the S&P 500, down 6%, rounding off its worst week since March of 2020.
Yeah, and we are still drifting lower, only fractionally in futures, but it kind of gets a sense here that the dip buyers aren't ready to come back yet. Obviously, a lot could transpire over this weekend.
Yep.
We're waiting to see what Europe might do in retaliation. We still haven't heard definitively from Canada or Mexico just yet as well, so that could be a wild card. And do you want that exposure until you actually get some clarity on it?
Absolutely. And the VIX, by the way, is revisiting its highs of the session, currently at 45.31. Earlier, it would hit 45.61.
Yeah, and I do wonder, too. I mean, we were talking a little bit earlier about the potential bright spots. You saw the XHP, the home builder ETF, actually rise. I guess in theory, because with rates dropping, that somehow everyone's going to go out and buy a home, I guess, if they're not feeling confident. But it gets to the broader question that if we do see dip buying come back on Monday, where is that going to be? Is it going to be in, say, big cap tech, kind of like the big cash generators? Is it going to be more cyclical stocks? I'm just curious as to where you think people's heads would be.
Dividend-paying stocks, maybe?
Safety.
Safety.
Yeah.
And, of course, if companies are looking to conserve cash, they're going to stop their share buybacks first before they make any changes to their dividends.
Good point. We should also point out, too, that Bloomberg Surveillance, where it's going to have special coverage on Sunday evening, starting at 5 p.m. New York time, to kind of set you up here for what may actually happen when global markets open from Asia to Europe and, of course, back here in the U.S. You're watching The Close on Bloomberg.
The NASDAQ 100 entering a bear market, meaning it's down more than 20% from its record high. Joining us now is Dan Niles, founder and portfolio manager at Niles Investment Management, to talk all things tech. And Dan, at the start of the year, when you were looking at your top 5 picks, you actually led with cash, which just tells us everything we need to know about where you stood and where your head was. How much further do we have to go in this slide? And I'm guessing that there's more to come, given there's still so much uncertainty. Do you just double down on cash? You can't lever up on cash, can you?
Well, you got to remember, cash at the start of the year was yielding 4% in a money market fund. And so my view was, coming into the year, valuations were high to begin with because you had a trailing S&P 500 PE of 25 times. And if you look at it over history, when you've had inflation between 2.5% to 3%, and obviously it's a little bit higher than that right now, but I was trying to be optimistic. The average multiple is 19 times, not 25. Now, if you're in a stagflation scenario, you're talking more of multiples that should be in the mid-teens. And even with the drop today, the multiple is only down to about 21 times or 22. So obviously there's still more downside potential in the market if you're repricing risk to a good level. And I think the thing that people forget is that S&P 500 earnings were coming down from the middle of last year. And people just sort of ignored that because the Fed's cutting rates and the stocks are going up, and so everybody's very bullish. But underneath it all, Amazon, Microsoft, Google, when they reported their June quarters, were cutting for the September quarter. And you had already started that drop, which is why I came into the year negative. So there's some issues with earnings underneath this that was already going on, and the tariffs have just sort of brought some of that to the forefront and the high multiples you have.
Dan, is your base case now for a recession? You mentioned stagflation, and that kind of was the working assumption last week. Have you switched to recession as your base case?
That's getting tested minute by minute. It wasn't. But then I saw today the TikTok deal, getting pushed out for 75 days. And my hope had been over the weekend, you had one of two things happen. The TikTok deal happens, and then the U.S. cuts the tariffs on China, and China cuts the tariffs on the U.S. But in fact, it seems like maybe China actually scuttled the deal. The second thing is, I'm hopeful that you could get an Intel TSMC joint venture, in which case the U.S. could drop tariffs on Taiwan, which is obviously very important to us in terms of semiconductors and other things that come out of there. Semiconductors are on the excluded list, but there's other things around that to try to de-escalate this. But right now, it looks like it's going obviously in the other direction. So that's what concerns me. There's absolutely no valuation support. I know people like to say stocks are cheap, but that's absolutely ridiculous. They're just cheap relative to where they were earlier. That doesn't make them cheap on a relative basis. And that's also why if you look outside the US, stocks, the global stock market, excluding the United States, is actually up 2% year to date, roughly. So that tells you there's something else going on besides just tariffs. The emerging market ETF, EEM, is only down 3%. The Eurozone ETF is actually up 5% year to date. And the Mexico ETF is up 7% year to date. So if this was really all about tariffs, Mexico should be getting killed, Europe should be getting killed, emerging markets should be getting killed. But it's actually the U.S. stock market that's down the most. Yeah. And if you switch to tech stocks, KWEB, which is the internet ETF for China, is up 7% year to date, and the Magnificent Seven are down 24%. So obviously valuations, earnings growth, that has something to do with this as well, not just tariffs.
Yeah, and it's interesting too, because when you look at those numbers on a year-to-date basis, even on a weekly basis, even though everything was down across the world, you can see the outperformance on a relative basis overseas, outside the U.S., if you will. I guess the question, though, Dan, is do you see a scenario where investors would rush back into U.S. equities? And one reason why I ask is a lot of the volatility that we saw intraday in retail and apparel companies after we saw those headlines that maybe potentially there was some sort of discussions about Vietnam getting a little bit of a reprieve, where, of course, a lot of these apparel goods are made.
I mean, it could be, but I think what people are doing now, which maybe you could argue they haven't done since COVID, is actually look at relative valuations and risks. And that's not something that people have paid a lot of attention to. And that's part of the reason why you're seeing things like internet stocks in China up 7% year to date, while Magnificent Seven are down 24%, because a lot of the China internet companies are trading at half the valuations of the US ones. But their earnings are actually getting revised higher, whereas if you look at 6 of the 7 Magnificent Seven, when they reported their December quarters or calendar Q4, they guided below the street for the March quarters. Mm-hmm. So there's also some differences there, which is why I'm not sure people are going to rush back in and do the FOMO, buy the dip. Because the Fed also, on the margin, they've got a dual mandate, and they're worried about inflation and what the tariffs could cause. And don't forget, you go back to early February, we were worried if the Fed might need to raise rates. I'm sure that's like ancient history for some people, but that's how bad things were. So the Fed is kind of in a tough spot because they're worried about growth on the one hand, but the scenario they absolutely positively want to avoid is 1970s style stagflation, because that's the one where the market goes down another 35% from here to get to a mid-teen multiple. Yeah. And that's the scenario they got to avoid at all costs.
Well, it looks like that scenario might be starting to unfold. Real quickly, Dan, we are heading into earnings season. Still going to be another 2 or 3 weeks before we really start to see results out of the tech companies. I think some of the concern that we've seen in this market, and you make a good point about fundamentals not necessarily being supportive of rushing back in, that's largely because we haven't really gotten an update from these companies that takes into account the potential economic impact from the tariffs. Assuming that they are willing to deliver some sort of outlook, what do you think that outlook's going to be?
Well, as I said earlier, Romaine, 6 of the 7 Magnificent Seven already guided below the street for the Q1 period when they reported 90 days ago when they reported Q4. So things already were problematic, which is why I came into the year with no Magnificent Seven in my top 5 picks for the first time in several years. And so clearly what's just happened is going to make that situation worse. Luckily for certain companies that are services based, obviously more so, like Google and Meta, they don't get a direct impact. But unfortunately, car companies are one of the biggest advertisers. And so if you have, consumer packaged goods, and so if they're feeling less certain about what to do, they're going to cut back on spending. Apple obviously has gotten crushed this week because they are in the crosshairs of some of this tariff stuff. They weren't exempted, which they were the first Trump term from some of the tariffs. And so, right now, I think it's early to go bottom fishing for one simple reason. If you look at some of the companies that have reported recently that are off-quarter companies, FedEx, Nike, Lennar, Micron Technologies, they all had low expectations. They all reported, and the stocks got crushed anyway. And yesterday, Restoration Hardware is an example of low expectations, and the stock went down 40% yesterday, and it went down more today. So until you see numbers getting cut and then stocks not getting crushed off of it, I'd be very careful about bottom fishing because, as I said earlier, the overall market multiple is still relatively high.
All right, Dan, got to leave it there. Dan Niles over at Niles Investment Management here. And of course, we start to get those tech earnings in about 2.5, 3 weeks or so. But even less time than that, just about a week's time, we are going to start to get earnings out of the big banks. A week from today, we're going to hear from Wells Fargo. We're going to hear from JP Morgan, Morgan Stanley, and a few others here on a day where the S&P 500 financial index actually had its worst day going back to the onset of the pandemic in 2020. Gerard Cassidy joins us right now, head of U.S. Bank Equity Strategy at RBC Capital Markets. And I am curious as to whether this earnings season for banks is going to be a bit of a tale between two cities. I mean, if you have a huge trading business, I would assume you're knocking it out of the park. If you got a big investment banking and deal-making business, I assume things are probably a little bit dormant on that side.
No, Romaine, you said it well, and trading results are likely to be very strong, especially obviously in the month of March with all the volatility. But I think what you're going to find is not only the investment banks who have obviously those lines of businesses, it's the commercial banks, and what are they going to be saying about the outlook? So I think the focus for most investors will be not necessarily on the results this quarter because the quarter has changed so much, but more what are their customers thinking about the rest of the year? So I think there'll be the guidance questions will be most of the focus on the first quarter calls.
Absolutely. And of course, for banks, their most costly part of their business is their talent, the headcount. Bloomberg is reporting that inside JP Morgan, inside Goldman Sachs and Bank of America, these executives are considering revising down internal projections for their advisory businesses because that M&A explosion that so many people expected after Trump was elected simply has not materialized. What are you looking for when it comes to headcount costs and the ratcheting down of those expenses?
It's interesting because, as you point out, the advisory business and also the ECM business, which is the IPO business, have gotten off to a very slow start. And then, of course, we've had the issue with the tariffs, which has only compounded those issues. So there may be the need to lower expenses through headcount reduction because that's the obvious expense of an investment bank. So we'll have to see, but they have to be careful because this could be a temporary lull. We might see M&A activity pick up in the second half of the year. So you don't want to cut your nose to spite your face. But you're right. It is something that is likely to be discussed on the earnings calls as a way of managing expense growth over the near term.
Of the companies in your coverage, Gerard, which ones look the strongest to you, given the environment that we're in right now?
Romaine, when we look at the banks, you have to look at the regional banks. They're very well capitalized. They have limited overseas business. And as a result, they should do okay in this quarter. Now, of course, it's all about what's going to happen to the economy. And we all expect it to slow down in economic growth due to these tariffs. But the credit quality for these banks are all very strong. So when you look at names like Fifth Third or Regions, PNC, M&T Bank, all of them are very strong. And even the large banks, when you look at a Wells Fargo or Bank of America, JP Morgan, very strong from a credit quality, liquidity, capital standpoint. But until we get the washout in the selling, it's going to be tough for these stocks over the very near term.
Okay, so credit quality is good. That's something that the banks themselves can control. What about demand for loans? What do you anticipate to hear from these banks?
It's a very good question because loan demand has been soft. We just reported the H8 data this afternoon. Loan growth on a year-over-year basis this week was up over 3% for the industry. And we anticipate that the banks are probably going to suggest that many of their corporate and commercial customers have put their loan borrowing demands on hold until they can figure out how they're going to maneuver and navigate through this new tariff scenario that has come out this week. So loan growth, which we thought at the start of the year was going to be somewhere north of 5%, is probably going to come in closer to 2 to 3% as the economy slows down in 2025.
All right, something we'll be looking for when the banks begin reporting next week. Gerard, always appreciate your joining us. Gerard Cassidy is head of U.S. Bank Equity Strategy at RBC Capital Markets.
One of the great voices that we've had on the program all week long as the turmoil and the fallout from Trump's tariffs reverberate around the world. Here's some of those voices that we heard from this week.
I think this is the worst economic policy in almost 100 years. And the economy recession probabilities have probably gone above 50% now.
There is really few indicators that suggest this will not be substantial in terms of its impact in a negative way to the economy.
The fact is, everybody is putting more probability of recession, although I will admit economists don't have a whole lot of credibility in calling recessions.
We're talking about the possibility of some sort of a mild recession. For these countries, you're talking about a serious depression if they really get cut off from the U.S.
We have now moved to a little bit worse than our worst case scenario, and that's because the tariffs now are likely, if they, even with some rollback and some negotiation, they could easily hit the highest level since the early 1900s. That, with more retaliation, would get us into a recession.
And you really only hear the best and brightest voices right here on Bloomberg Television. Some degree of levity out of those voices, but also a great deal of concern, particularly on a week that will go down, Scarlett, as one of the worst weeks for financial markets since at least the start of the pandemic.
And some people will say it because of self-inflicted wounds, because the economy was doing fine before the announcement of these, the April 2nd tariffs, which really ratcheted up the costs for companies. The other thing that was interesting, of course, is this idea that it's not just the tariffs, but valuations were lofty and continue to be lofty.
They continue to be lofty. We heard that from Dan Niles. And of course, we have the start of the earnings season. Effectively starts on Wednesday when we get Delta and then the big banks on Friday. We'll have a lot to cover right here on The Close. We hope that you join us next week, but stick around. A lot going on in Washington, and the Balance of Power team takes over now.